Hi, my name is Sheldon Stone. I am a co-founder of Oaktree Capital Management. I'm responsible for the high yield bond area. A high yield bond is a security issued by a U.S. corporation. It is a fixed income, meaning it pays its interest semi-annually, and it has a maturity, meaning you will get your money back. The issue with high yield bonds generally is understanding the risk of their ability to repay, and that's where the analysis comes into play. So rising interest rates are generally a negative to bonds, and the reason is pretty simple. If you own a bond with a fixed interest rate, let's say hypothetically you have a bond that has a 6% interest rate. If the market rate increases, your bond is not worth as much because individuals can go and buy a new bond at that higher rate, which means that if you were to sell your bond, it would be at a lower price, arguably, than you purchased it for. So high yield bonds have an advantage of being less interest rate sensitive than higher rated bonds. And the reason is quite simple. With higher rated bonds, they tend to have a maturity or repayment many years beyond what a high yield bond would mature. And also they have a higher interest rate, and that higher interest rate means there's less sensitivity to rate movements. Many times investors will say, gee, investing in high yield bonds is risky. Aren't some of these companies going to default? And the answer is yes, some will. I do believe that one can analyze credit and along the way manage some of that risk. But to me, the analogy is the life insurance industry. There is probably no more conservative industry in the world than insurance companies. They're paid to manage risk. They know that all of us are mortal, and eventually they will have to pay that life insurance premium. So how do they do it, and why do they do it? And I think it's directly applicable to the high yield bond market. One, they accept risk that's analyzable. They have actuaries who will look at expected lifespans. Secondly, they have diversification, meaning they're not going to write insurance policies for skydivers who live on the San Andreas Fault. That would be imprudent. And finally, they charge the right premium, meaning the rate you pay is designed to keep the insurance company solvent. Same thing with high yield bonds. I know they're risky, I know they can be analyzed, and I need to make sure I get compensated fairly for the risk to earn an excess return. So the Federal Reserve is concerned about inflation, as all investors should be. And their action is to try to raise interest rates so that would dampen some of the, I guess I would say, demand. When low interest rates exist, there's temptation to buy more things, whether it's cars, whether it's homes. And if you want to control inflation, you want to make interest rates higher because of its ability to cause the economy, hopefully not to become a recession, but to have more sustained lower growth. I have an interest in history, not just financial history, but US history. Economists look back at this period, they will say we went through a period of great shock, whether it was the global financial crisis, which caused tremendous pain to the banking sector and to the economy around the globe, COVID more recently. I think the actions that were taken by, for instance, the Federal Reserve were prudent, but like anything, there are consequences, and historians will probably look back and say, maybe we kept interest rates too low for too long.